As of 11:20 a.m. Eastern Time on Tuesday, December 23, 2025, IonQ is trading at 53.86 USD, marking a significant intraday jump of 5.38 points, or 11.10% since the opening bell. This move is not just a random fluctuation in a quiet holiday week, it is a clear signal that the appetite for high-growth tech is shifting toward the next generation of computing. While many traders are watching the steady climb of Apple stock or the latest volatility in NVIDIA stock, the real action is happening in the specialized hardware space, where IonQ is currently outperforming the broader market. The expectation for most retail investors has been that quantum computing is a concept for the next decade, something that stays in the lab while the big names like Tesla stock handle the immediate gains. However, the reality we are seeing today is that the commercial window is opening much faster than the consensus predicted. Today's double-digit move follows a series of institutional upgrades and a massive expansion of the company's European footprint. Specifically, the market is reacting to the realization that IonQ is no longer just a research project, but a revenue-generating entity that is hitting technical milestones months ahead of schedule. Most people look at the ticker INOQ and see a speculative play that is too early to touch. They think they need to wait for a full-scale machine to exist before they start looking at investing sites for an entry point. But if you wait until the technology is perfected, the price discovery has already happened. The smart capital is moving now because IonQ recently achieved a world record 2-qubit gate fidelity of 99.99%. That number might sound like technical trivia, but in the world of computing, it is the difference between a toy and a tool that can actually solve pharmaceutical and logistics problems that classical supercomputers cannot touch. You see, the common ground among investors is that we're in a high interest rate environment where speculative tech should be suffering. The general belief is that unless a company has massive free cash flow, like Fidelity wealth management clients typically look for, it should be avoided. But challenging that belief is the fact that institutional inflows into IonQ reached over $2.5 billion in the last 12 months. Major institutions like Vanguard and Morgan Stanley have been aggressively increasing their positions, treating IonQ not as a lottery ticket, but as a strategic asset. While many people use their Robinhood app to trade the daily swings of meme coins or quick tech bounces, the big players are using their individual brokerage accounts to build long-term stakes in what they see as the backbone of the next century's infrastructure. If we look at the recent price action, IonQ has been acting as a leading indicator for the entire quantum sector. Earlier this month, we saw the stock pull back into the mid-40s as investors took profits from the October highs, but the support at the 50-day moving average held firm, and today's breakout above the $50 level suggests that a new leg of the bull run is starting. This momentum is supported by the recent deal with Quantum Basel in Switzerland, which is valued at over $60 million. This is a massive contract for a company of this size, and it involves the actual deployment of their Forte enterprise and next-gen Tempo systems. It's a shift from maybe one day to here is the invoice. When you see that kind of commercial traction, it changes the conversation from a research story to a business story. For those of you managing your own portfolios through interactive brokers or perhaps using a SoFi active investing account, the question is often about timing. Why buy now instead of waiting for the next earnings report? The reality is that the market is beginning to price in the scarcity of pure-play quantum stocks. There are very few companies you can actually buy on the NYSE that are doing this at scale. When a sector becomes hot, like AI did in 2023, the first few companies with a working product get a disproportionate amount of the capital. This is exactly what we are seeing with IonQ. It is the largest pure-play quantum name by market value, making it the first stop for any institutional fund that wants exposure to this specific technology. It is worth noting that while some are using Schwab Intelligent Portfolios to get broad market exposure, the individual stocks within the tech sector are starting to diverge. Companies that are just talking about AI are losing steam, while companies building the actual hardware to run the next level of algorithms are gaining ground. IonQ is currently in that sweet spot. Their business model is built on providing quantum computing as a service through all the major cloud providers. Whether you're using Amazon Web Services or Microsoft Azure, you can access IonQ's hardware. This means they don't have to build a global sales force from scratch. They are piggybacking on the largest tech ecosystems in the world. Take a second to think about your own strategy right now. Comment below how many shares of IonQ you currently hold, or if you are waiting for a specific price target to enter the position. Your perspective helps everyone in the community see how the sentiment is shifting on the ground. Looking back at the history of this company, it was founded on the idea of trapped ion technology. Unlike superconducting qubits used by some of its competitors, trapped ions are naturally identical and can be controlled with high precision using lasers. This is why they were able to hit that 99.99% fidelity record. While others are struggling with error correction and heat management, IonQ is scaling up their algorithmic qubit count in a way that is proving more stable. This technical advantage is what led to their inclusion in the Deloitte Technology Fast 500 recently, showing a revenue growth of nearly 2,000% over the last 3 years. That is not a typo. The growth is real, and it is accelerating because the cost of accessing these machines is coming down while the power is going up. In previous reports, the company has consistently beaten revenue expectations, but the market sometimes punished them for their high burn rate. That is the tension between expectation and reality. The market expects a startup to eventually become profitable, but the reality is that in a winner-take-all hardware race, you have to spend capital to maintain your lead. The fact that their partnerships are now expanding into $60 million deals suggests that the path to a sustainable business model is much clearer than it was even 6 months ago. We are seeing a transition from an experimental phase into an early commercial deployment phase. As we look toward the future, the outlook for IonQ is tied to its 2030 roadmap, where it intends to reach 2 million qubits. If they hit even a fraction of that goal, the current valuation of around $19 billion will look incredibly small in hindsight. The risk, of course, is that a competitor could find a more efficient way to scale, or that the quantum winter narrative returns if the applications don't materialize as fast as the hardware. But for now, the catalysts are all pointing upward. We have seen Wedbush initiate coverage with an outperform rating and a $60 target, and Jefferies even suggested it could go as high as $100 as the market starts to treat quantum as the next massive secular trend. The macro environment also plays a role. As the Federal Reserve signals a potential shift in policy for 2026, the cost of borrowing for high-growth tech firms might stabilize, which would be a huge tailwind for companies like IonQ that are still in their expansion phase. If you are using SoFi Investing or a Robinhood account to trade these moves, you have to be aware of the volatility. A stock that can go up 11% in a morning can just as easily pull back 8% on a Friday afternoon if the broader tech sector sees a sell-off. But the long-term trend for IonQ has been a series of higher lows throughout 2025, which is a very healthy technical sign. When you compare this to other tech favorites, the growth potential is on a different scale. Apple stock provides stability and dividends, but it isn't going to grow its revenue by 2,000% in 3 years. Even Nvidia stock, as great as it has been, is now a multi-trillion-dollar company where the massive gains are harder to come by. For someone looking for a high-risk, high-reward component to their self-investing strategy, a small position in a leader like IonQ offers the kind of convexity that you just can't find in the mega-cap names. This is why more and more people are looking for investment help to understand how to size these positions without taking on too much risk. Whether you prefer the Fidelity trading platform or you like the simplicity of the SoFi trading platform, the key is to stay informed on the specific specific technical milestones that drive these stocks. IonQ isn't just a tech stock, it is a hardware play on the very nature of how we process information. If they continue to prove that their trapped ion approach is the most scalable, they could become the Intel of the next 50 years. The current price of $53.86 USD is a reflection of the market starting to believe that this isn't science fiction anymore. In summary, the expectation was that IonQ would remain a speculative low-revenue play for several more years. The reality is that they are closing multi-million-dollar international deals and setting world records for hardware fidelity right now. Today's 11% move is a reaction to that gap being closed. We saw institutional funds flow in, we saw analyst targets raised, and we are seeing a clear technical breakout. The contrast between the cautious general market narrative and the aggressive institutional buying is where the opportunity lies. If you are managing your own Fidelity IRAs or building a portfolio on the Robinhood app, it is vital to distinguish between